Now, we are going to do today this little chapter. I call it bond valuation and bond yield. This is actually an article that appeared in September 2011, and it's written by your examiner, your current examiner. Okay, now in this particular article, we are going to learn a few things. Yeah, there are 5 mini examples here, and that is what I'm going to explain to you in this particular explanation. Now, the first one is going to be bond value or bond price. This is what we're going to learn. Now, in this example, now you must understand that the price of a bond is always the present value. The price of the bond is actually the present value of the future cash flows. Is that okay? The price of a bond is actually the present value of future cash flows. If it's dated bond, then you're going to have 2 cash flows, which is going to be interest, a stream of interest payments, plus on the last day you're going to have a redemption value. That if it is a dated bond. If it's an undated bond or irredeemable bond, then you only have interest in perpetuity. So in this case, it's going to be dated bond valuation. So you must remember, it's the present value of future cash flows, interest plus redemption value. Now when they say it's the present value, that means you need to have a discount factor. The discount factor is actually the yield to maturity. Yeah, the yield to maturity. For the investor, we call it yield. For the company, we call it cost of debt. So my yield is the company's debt. Okay, so now this example, we have it here. How much would an investor pay? That means we want to find the price to purchase the bond today, which is redeemable in 4 years for its par value. It's redeemable in 4 years. The redemption value is at par value or face value of 100, and pays an annual coupon of 5% on the par value. The required rate of return or yield for a bond in the class is 4%. This is called yield to maturity. For this class, everybody out there is asking for 4%. So how are we going to find the particular value of this bond? Now, so you're going to say the price, example 1, example number 1 is going to be year 1 up to year 4. Let me change to a nice color. Okay, year 1 up to year 4, you're going to have an interest receipts. Okay, you're going to receive interest, and the interest receipts, you must remember, the interest is always calculated on coupon rate multiplied by its par value, which is 100. So in this case, you are going to get interest of $5, and on the very last day, which is going to be year 4, you are going to get a redemption value if you have made an investment. So what is going to be here? You're going to get $100. So what are we going to do? We're going to find the present value for these cash flows, and to find the present value for these cash flows, you're going to have to discount it at yield to maturity, which is your discounting factor already given in the question, which is going to be 4%. So this is going to be 4%, and if you look at your annuity tables, if you're comfortable with the table, I think all of you like to use calculators for this one. which is very fast. Okay, so if you use your calculator or the table or the formula, you should get 3.630, and this is on its own, so this has to be the discount factor. This is the annuity factor, this is the discount factor, this is going to be 0.855. Multiplying it, you're going to get a present value of 85.5 over here, and this is going to give us an answer of 18.15. okay, so you're going to get the price as a sum of this figure. That's going to be the price. So how much would you pay? You would pay 103.65. Is that okay? So we are going to get 103.65 as the price today. Okay, so what did you learn here? You're going to learn that from this example, the price of the bond is actually the present value of future cash flows. So in other words, if you buy this bond today at $103.65, every year they'll give you $5. One more year they give you $5, then they give you one more $5, then 4 years $5, then the last day they give you back that $100. Actually, you are getting a return of 4% every year. That's what it means. Okay, now so so this is another way of presentation. That means you're doing year by year. Is that okay? The examiner took an approach year by year, and of course there'll be a slight difference in answer, of course, because this is taken as a whole. Yeah, as a whole, we took it as 3 decimal places. Fine, no problem. Yeah, I'll give you full credit for any of the methods. So you're going to get 103.62. okay, so that is what you have here. Now in that same example, what if now the yield moves to 6%? Okay, if the yield moves to 6%, now what is going to happen to the price? Now let's calculate. So let's calculate if it's going to be now 6%. So we're going to have the same story here. We're going to have the same story. Year 1 to year 4, you're going to get interest, which is going to be $5. Year 4, you're going to get a whole lump sum at par value or face value of 100. The discounting factor is going to be 6%. Now if it's going to be 6%, then you use your annuity factor table or your calculator or the formula. You're going to get 3.465, and this should give you 0.792, giving you 79.20, and this is going to be 17.33, and you're going to get something here called 96.53. So what have happened here is that the price have changed in line with your yield to maturity, or the return required by the investor. So if the return or your cost or your interest goes up, okay, when your interest goes up, the conclusion we can make here, if my interest from 5 go to 6, if it goes from 5 to 6, earlier was 5, sorry, earlier was 4, right? Sorry, earlier was 4. If it's going to be 4, your price is 103. If it's going to be 6, it's going to be 96. So there's a change here. There's a change in price. 1% up, the price changes by a certain amount. So we can come to a conclusion here. We can come to a conclusion. I'm going to write the conclusion here. When my interest rates or the yield or whatever goes up, the price of the bond will fall. Is that okay? The price of the bond is going to fall. Now, let's go to the next page. Let's go to the next page. Now, in that page, we are told that if the yield is equal to coupon, which is 5%, you can try this one. Yeah, if it's going to be 5%, trust me, your answer is going to be $100 exactly. Okay, you can try it at home later. Alright, you're going to get here around $100, which is current price. So the conclusion here is that it has got an inverse relationship between the yield of the bond and its price. So if the yield goes up, the price goes down. It's called inverse relationship, and vice versa. Okay, the higher the rate of return, the lower the price of the bond it's going to be. Okay, but it should note that the relationship is not in a straight line, but it's in a convex kind of curve. Is that clear? So when your interest rates go up, this is your yield. Yeah, this is your yield. Let's say your interest rates go up, your price will start to fall. Okay, now, so that's what you have here for example number 1. Now, second example. Yep, second example. Of course, all this you can read on your own. Okay, it shouldn't be a problem. Now, the second example is examiner is trying to tell us how to find the yield to maturity. Yeah, the yield to maturity is actually a one rate only. Yeah, one rate. Yield to maturity, one rate, or is also known as gross redemption yield. Now, how do you do this one? Usually, you do it by IRR formula. Okay, so we have, for example, let's try this one out. Example number 2. Now, example number 2 is that we have a coupon of 7%, which is redeemable in 5 years at par, and is currently trading at 106.2. So they tell us the price. So remember, if you want to find yield, you must have a price, and at the same time, if you want to find a price in example 1, if you want to find the price, if you want to find the price, you must have the yield. Either way, you must have one of those items. Okay, so here it says the bond pays a coupon of 7%, redeemable in 5 years time at par, and is currently trading at 106.92. Estimate its yield. Now you have to use an IRR approach. You need to have 2 discounting factor. Okay, you need to have 2 discounting factor. So what are we going to do here is, first of all, you need the cash flows. It's just like an investment, you need the cash flows. So what are the cash flows here? You have, this is example number 2. Example number 2, we have here year 0. The price is going to be 106.62. Now try to write as left as possible, because it involves some IRR calculation. Now year 1 up to year 5, your coupon, how much is your coupon? Your coupon is 7%. Alright, your coupon is 7%, and in year 5 you are going to get back your redemption, which is $100. Okay, and in year 5 it's going to be redemption at $100. Now, what is going to happen? Now, these are your cash flows. I need to have, what do you call that, 2 discount factors. So we're going to have some space here. We're going to have some space. We're going to have 2 discount factors. 1 discount factor, 1 PV, 1 discount factor, 1 PV. So we're going to stand by and we're going to put the discount factors here. You can guess any discount factors you like. Try to make it like one positive NPV and one more is negative NPV. Okay, so we're going to have these present values here. We're going to have this present value here. Now, then we're going to have this IRR, or the yield to maturity. We're going to tell the examiner that this is going to be equals to IRR method. Yeah, more or less IRR method, which is equals to small a plus big A over big A minus big B, small b minus small a. Yeah. Keep all the space here that you have in exam. Just make sure you have enough space. Now what I'll do here for you, now we're going to guess the rate first. Now it's a good guess. Yeah, we're trying to guess what is going to be your first discount rate. Now your first discount rate, try to, because you must understand, you have to understand that the actual relationship between, if it's an investment appraisal, let's say it's convex, it's actually a curve kind of thing. If you take one discount factor, if you choose one here, and if you choose one more here, and if you're going to take the formula is actually a linear line. They're going to give you a linear line, and this is going to be actually your calculated IRR, but this is your true IRR. Is that clear? There will be a margin of difference. Doesn't matter, you will still be marked correct in exam. Now, but if possible, now I like to do this way. I like to find the smallest positive NPV, and I'll try to get the smallest negative NPV at a rate. Then I'll take a shortest ruler that I have, and I'm going to connect these two lines here, and I'll notice that there's no gap or whatsoever here. This is like there's no much of a gap. So what are we going to do here? I'm going to take the smallest positive and the smallest negative. So how do you do that? What I do usually, I do an approximation IRR. Okay, we'll do an approximation IRR. So IRR approximation is equals to, now the cash flows are already there. So what are you doing? It's going to take 7 multiplied by 5. Yeah, you're going to take 7 of this is multiplied by 5 plus 100. This is my cash flows that I'm going to get, plus 100. So I got actually 135. Now to get 135, I have to make one investment today, which is 106. Yeah, I have to make one investment today, which is 106.62. Yeah, 106.62, and we're going to divide this with 5 to get a profit. This is actually profits. Notice this is my profits for 5 years in total. So when I divide by 5, I'm going to get average profit per annum. So what I'm going to do now, I'm going to just total this up, and I'm going to get an average of the investment, which is 106.62 plus 100 divided by 2, and you're going to get an answer here. We're going to get one answer here at 4. This is what you call by. This is similar to your ARR formula that you commonly use in F9. Correct? Similar to ARR formula. Profits, average investments, and you should get something like 5.49%. Yeah, you should get something like 5.49%. Now, that is what I would do, and if I have the time, seriously, if I have the time, I would come back later, yeah, and I'll fill up this, because marks are given for this calculation. Yeah, don't lose these marks. Yeah, if you got no time, fine, but if you have the time, you won't have the time. Actually, in P4 you might not have the time, but anyway, if you have the time, means you don't have to do many questions. Now if you have the time, come back and fill up this. So you have 5.49 is approximation. So what's the best first rate using this concept? What's the rate? 5.49. This is 5.49, and this should be 5. This should be 6. 5 and 6. I'm going to take 5. I'm going to take 6. So I'm going to take 5 as the first rate, and I'm going to try and take second as the second rate. It works. Yeah, one will be positive. I guarantee you, one will be positive, and one will be negative. So this is going to be 1. So let me calculate. 1, 2, 3, 4, 5. This is going to be 0.784. Recall your memory, you're going to get 4.329. This is 106.62, and this is 78.40. This is going to be 4.329 times 7. You're going to get here 30.30. Yep, 30.30. 30.3 plus 78.4 minus 106.62. This is positive 2.08. Now we're going to try 6% now. Clear your memory. Okay. So 6. 1, 2, 3, 4, 5. This is going to be 0.747. You recall your memory. You're going to get here 4.212. Yeah, I would say this is negative, but don't multiply with this figure. You sure get positive, right? You got to multiply with this figure. You got to multiply with this figure. You got to multiply with this figure. Okay. So the first one is going to be 106.62, and 7 times what? 4.212. Going to get you 29.48. 0.747 times 100. It's going to give you 74.70. 74.70. Take away 106.62. This is going to give us 2.44 negative. Is that clear? This is going to be 2.44 negative. So one positive, one negative. Beautiful. The answer is in between. So this is going to be your small a, lower rate. This is going to be your small b, higher rate. This is going to be your NPV of small a, and this is going to be your NPV of small b. So put in the figures. This is going to be 5 plus 2.08. 2.08 minus in school we are always taught to plus 2.44. Okay, now this is going to be 6 minus 5. Actually no use, because we always try to work out in 1% difference, so it doesn't matter. So in this case anyway, we'll just make sure we fill out the thing. So what is your answer now? This is why you're going to get marks. Yeah, 2.08 divided by 2.08 plus 2.44, and then you plus 5, you're going to get 5.46%. Yeah, I purposely open up into 2 decimals so that if I round it up to 5.5, then here also would have been 5.5. Looks like there's no change. There's no differences. Actually, there are some differences here. If you use this method, you're going to get 5.46. If you're going to use this, 5.49. So this is actually a guide for you to start off your IRR calculation. Marks are given for IRR calculation. Yeah, do it last. I would suggest you come back and fill up last. You got a time, you come back and fill it up last. So you got 5.46 is going to be our answer for the IRR calculation. Examiner used IRR method and he got 5.46 as well. Okay, now, so the second example is about finding the yield. Alright, the second example is finding the yield. The first one is finding the value using the yield, and you must understand this yield is one yield for the whole period of the bond. One yield for the whole period of the bond. Now the next thing what we're going to do is we are going to the following page. Okay, we're going to try and see the third example, which is going to give you different yield for each years. Yeah, different yield for each year. So you're going to have valuation of the bond. This is going to be value. We're going to determine the price using, instead of one yield, we're going to have 3 or 4 each year different yield. Yeah, I will try to interrelate the each year yield and the one yield to maturity in a while using yield curve. Yep, price using an yield curve. Now, look at this example here. A company wants to issue a bond that is redeemable in 4 years' time for its par value or face value of 100 and wants to pay an annual coupon of 5% on par value. What's the price in which the bond should be issued? Now, you must know either the yield to maturity to find the price, or in this case they didn't tell us the yield to maturity. They didn't tell us the price, but what they told us here is that they told us the spot yield curve for different class of the bond. That means if you invest your cash flow for 1 year only, then you should be given 3.5% yield. If you invest your cash flows for 2 years, then you will feel that cash flows that you're investing for 2 years is giving you a yield of 4%. And if you invest your cash flows for 3 years, and you will effectively, for that 3-year cash flows, you're going to get 4.7%. And if you invest it for 4 years, you're going to get slightly higher. So it looks like it's an upward sloping yield curve. The longer you invest, the more yield you're going to get each year. Now, trying this example, you have a 4-year bond. Okay, a 4-year bond that pays a stream of, this is 4 years, you got a stream of cash flows $5 each year. Now, $5 each year, what is going to happen? You are going to get something like this. You're going to get $5 for the first year. Okay, put it this way. Let's go one by one. What's the value? Let's write. Yeah, you must write price is equals to the present value of the cash flows. Yeah, present value of the cash flows. You can find the present value if you have the yield to maturity straight away. But if you're not given the yield to maturity, then you have no choice. You have to use the annual yield spot rate curve. Okay, so that will be the individual discounting factor. Let me break it up. Year 1, you're going to get $5, assuming you're going to invest for 1 year. Okay, the return that you're going to get is 3.5%. 1 year later, you're going to get $5. How much would you invest today? That's the question. How much would you put in today? That is your price that you would pay today to get this $5. Working backwards. Okay, working backwards. So this is going to be unknown. But I know this is going to be my future value. So I'm going to discount this by the return that I'm going to get for 1 year of my investment. This is -1. I'm taking the whole value. This is actually a discount factor for year 1. Yeah, this can be returned as 1 plus r to the power of 1, or you can say 1.035 to the power of 1. I'm sure you all know aware of that. Yeah, this is a formula that's given in your formula table. Okay, so you have it here. So let's just break up this into 4 pieces of different investment. I want to get $5 in year 1, and I know they're giving me 3.5%. Then that means I must invest how much here? Today I must invest $4.83. Makes sense? So this is the price to get this. You follow? That's it. So the same thing we're going to do for the second one. Second year, you also want $5. You want to put something today, go and sleep for 2 years, wake up, and you want to see a $5. And you know that this 2 years, the return that you are going to, you want, what's your return that you're going to give you? They are giving us, the bank is giving us, everybody is giving us for that particular risk is going to be 4%. So how much would you invest here to get this $5? And you're leaving your investment for 2 years. So which means this is going to be 1.04 to the power of -2. What are you going to get here? You're going to get here 4.62. You can also do like this. 4.62 times 1.04 to the power of 2. It's a compounding formula actually. If you compound this figure, you're going to get $5, correct? So now what are we doing? We're discounting that figure to get the present value. And what is this? What is this? This is actually the price. This is what you pay today to get this. This is what you pay today to get this. This is what you pay today to get this. This is what you pay today to get this. And this is what I'm interested. This is what I pay today to get all of this. This is the price that we want to find. Okay? Now, year 3, I'm going to get another $5, and I'm going to sleep for 3 years and wake up later, and I want $5. So I am going to invest at the rate here is 4.7. Yeah, 4.7%. So it's going to be 4.7 to the power of -3. You're going to get 4.36. And the last one is going to be, you are going to get the redemption value plus also the interest. So the last year, you have to remember, this is dated bond. Dated bond, you add another 100. The par value is 100. You add 100 into the coupon rate. And this one is giving us a return. Everybody is getting a return of 5.55%. So this is power of 4. 5.5, right? Okay, 5.5. There you go. You're going to get this answer as 84.76. Okay, it's going to be 84.76. Now, so when you total this up, that's going to be the total investment. In other words, the price you would pay today. Actually, it's easy to explain if you take each as a different investment unit. You want $5? How much you pay today to get that $5 in year 1? Well, I must see what's my return I want to get. everybody giving 3.5%. So I'll pay for that $5, 4.83. I'll pay for this $5, 4.62 today. I'm going to get 4% return for that particular investment. So what am I going to do now? And this is going to be the price. The price is going to be, check, 98.57. That's my overall price today. If I pay 98.57, the company will pay me $5 later, 1 year from now, 1 year, 2 years from now, 3 years from now, and 4 years from now. And if you ask me what's the return I'm getting, I've got no choice, but I have to tell you this way. I have to tell you, the first year one is I'm getting 3.5%. The second year one, actually I'm getting 4% return. The third year one, actually I'm getting 4.7% return. And sorry, the third year and fourth year one, I'm getting 5.5% return. Or if you want to save your time talking too much, what you can say, you can now calculate the yield to maturity and tell them all this can be consolidated into one return, yield to maturity. So can we find the yield to maturity for this? Let's find the yield to maturity for this. Now again, this is going back to example number 2. Yield to maturity, we use IRR, okay, but for this purpose I will explain using the approximation IRR. You go back and try out the IRR calculations yourself. Now yield to maturity is actually one yield rate. It's going to be like this. I'm going to invest today 98.57. Yep, I'm going to invest at 98.57, and in year 1 to year 4, cash flows that I'm going to get is simply going to be $5, and in year 4 I'm going to get $100. Is that okay? In year 4 I'm going to get $100. Now, so what are we going to do here for the finding out the yield to maturity? Approximation. Yeah, I just wanted to safeguard myself. Just put approximation first. So we're going to get 5 times 4. It's actually an ARR method. 5 times 4 plus 100. Yeah, plus 100 minus 98.57. Okay with that? And we're going to have to divide it by 4. So that's going to be my profits per annum. This is my profits. This is my cash inflows. To get this, I must pay this. So sounds like my profit to me. Divide by 4. It's going to give me the profits per annum. So I'm going to divide it with my average capital. Average capital is opening capital plus closing capital. Divide by 2. So we're going to get here 98.57 plus 100 divided by 2. Okay, what do you get? You're going to get multiplied by 100. Well, approximately 5.4%. Is that okay? Approximately you're going to get around 5.4%. But then if you have the time, yeah, you have to. Marks are given. Especially if they ask you to find this. If they ask you to find this, then marks will be given for the IRR approach. Yeah, don't lose that marks. Okay, so I will use 5 and 6% and get the answer. So what are we going to get here? Well, let's see what happens next. Okay, so what the examiner have shown us the answer here. Yes, the same thing here. Examiners are yield to maturity, but examiner have used IRR. So you use IRR, you're also going to get 5.41%. Is that okay? Using the same methodology as example 2. Now what I want to show you here is this. What is this IRR? You see, example 2, you found out the yield to maturity. This yield to maturity is 5.41. Is actually one yield rate. Now, actually, it can be, their component is going to be based on this particular yield. 1 year yield, 3.5, 2 year yield, 3 year yield, 4 year yield. So if you look at it here, assuming this is a cash flow, you're getting $5. The yield for this cash flow is this. Imagine you break this into 4 investments. Then the yield for this is you're going to get this yield for second year, this yield for third year, this yield for fourth year. But if I want to say one yield to maturity, I'm going to have the answer as 5.4. Okay. So it simply means like this. You see what happens? I pay something today. I'll show you the breakdown. I'll show you the breakdown. I buy the thing for 98.57. It's just like you're investing. Put this money in the bank. 98.57. Now, you leave it there for 1 year and you wake up, you will feel that you're going to get 5.4 every year. You can feel you're going to get 5.4 every year, or you can feel you're getting different percentage each year. It's up to you how you feel. So today I want to get 5.4% every year. So what I'm going to do is I'm going to multiply by 1.54 for 1 year. So 1 year later, my investment should be how much? My investment should be 1.054. It's going to be $103, and I'm just rounding up to 2 decimals. Is that okay? 89 cents. So if I feel I want to get 1 year yield, then 1 year later I will feel my investment should be 103.89. Then I go to the bank. I want to go to McDonald's. So what do? I take out $5 from there, because the company is giving me coupon. So when the company gives you coupon, your investment actually drops. Unless are you reinvesting? No, you're taking it out and you're going to McDonald's and you're going to spend $5 there. So how much is your investment now minus $5? You're going to get here how much left over? 98.89. Now that's my second year. I'm going to sleep for 1 year. I'm going to wake up, and if I want to feel the same yield, it's going to be 1.05. 1 year, right? Every time 1 year. This is 1 year, right? So it's going to be how much? This is my second year. Multiply by 1.054. I'm going to get 104.23. Then what do? I'm hungry now. I want to go to McDonald's again. I'll take out $5. And this is my second time I'm taking out the money. So when I minus off 5, I will have a 99.23. So I'm going to sleep for 1 more year. 0.54 is what I'm getting. Every time I go to sleep, I feel I'm getting a return of 5.4. So multiply by 1.054, it's going to give you 104.59. Is that okay? Around there. Okay, so how many times have you taken out the coupon? So far 2. This is going to be my 3rd time. Now when you take out this one, minus 5, you're going to get here 99.59. Then you're going to sleep for the last year. This is the final year. That's finale. You're going to sleep for the last year. You're going to multiply by 1.054. Shall I write here? So multiply by 1.054. Okay, I'm just cheating here. Okay, I'm just cheating my answer. I'm just going to write here 105 due to rounding up adjustments. Yeah, you will get actually 104.97. Yeah, you'll get 104.97 because this is the time I'm going to McDonald's. I'm going to take out $5 and I'm going to withdraw all my money out now. So it's going to be $100. I'm going to withdraw and I get left nothing. So this is how I explain yield to maturity. Now, yield to maturity is actually one rate that you feel you're getting for the whole 4 years of investment. Or you can say, instead of saying 5.4% every year, you can say you're getting what? I put in so much today, I put in so much today. Let's put this in a different bank. What bank you have? HSBC. You put $4.83 in HSBC. Then 1 year later, you take out $5 for your McDonald's in HSBC. HSBC account closed. And today you put in Citibank. 4.62. 2 years later, you wake up, you go to Citibank, and you close the account there. This one you put in what bank? CIMB Bank. Okay, you put it in CIMB Bank. 3 years later, you wake up and you close your account. That means your return, you're getting this amount, correct? You're getting this amount. You're getting this amount. Actually, you are actually getting 1 yield or 4 yield. Up to you how you want to interpret. Is that clear? Okay. Now, so that was example number 3. Correct? Now, let's try. Let's move on. Let's move on to next example. Now, example number 4 is now we're going to learn how to find the yield curve. In example 3, we are told the yield curve each year is different. We are told in example 3 that the yield curve in each year is different. How did you get that yield curve? In practice, how it's done? Okay, estimating a yield curve. Now, what are we going to do to estimate yield curve? There are different methods, yeah, to estimate the yield curve, and common method is using the government bond. Yeah, using the government bond, and it's explained in example number 4. So let me just recap. First example teaches us how to find the price of a bond with one yield curve. Second example tells us how to find the yield to maturity, that is 1 yield. The third example, finding the price using different yield. Yeah. The next example is going to be how to determine the yield curve. How to find, how to determine the yield curve. Okay, how to determine the yield curve. Now, if you have 3-year yield curve, then you must have 3 bonds to be issued. Like for example, one is redeemable in 1 year. That means you take one government bond, 1 year government bond, one more is 2 years government bond, one more is 3 years government bond. Yeah, since all bonds are all government bond, they are all same risk class. Let's assume that the coupons are payable on an annual basis. Okay, good. Now, bond A is redeemable in 1 year's time. So bond A will help us to find the yield for the first year, which is coupon of 7 and is trading at 103. Okay, let's find the bond A's yield. Coming back here. Bond A. Now, bond A, the story goes like this. You are going to buy the bond at $103. That is the price, trading at 103. They're going to give you 7% coupon after 1 year, and since this is only 1 year's time, you're going to get back your par value of 100. So in other words, you are actually going to buy the bond today at $103, and 1 year later you're going to get back $7 plus $100, so you're going to get back $107. So what is going to happen is going to be, you're going to have a discounting factor. Now you need a discount factor, but then we don't want to use that way. This is always 1, correct? Today is always 1. Whatever rate you use, it's going to be 1. And you must know that whatever I'm going to put here, it must give me 103. You get a picture? Because I want to find my yield. My yield must be equals to NPV 0. The rate that I'm going to use is going to be NPV 0, so I have to use 103. So what's the missing figure? I tell you what, I show you in a different approach. It's something like this. It sounds something like this. I put $103 today. I'm going to compound this by 1 plus R to the power of 1, and it must be, when I wake up, it must be 107. Can I find R? That's what I'm doing here. Yeah, can I find R? So this is actually multiplied by 1 plus R to the power of 1 plus R to the power of -1. And this is going to be mathematically solving it. R equals to 107 divided by 103 minus 1 divided by 103. Is it 3.88%? In percentage, yeah, in percentage it's 3.881%. So actually you're getting a 3.881%. You could have solved it like this. You multiply by this equals to this, or you can just solve it like this. So first year bond, first year yield. Now we are going to go to the second year yield. How you find the second year yield? Now we are trying to find yield for each year, okay, not the yield to maturity. We are finding out the spot yield curve. Yeah, we are finding 1 year how much, 2 year how much, 3 year how much. If you borrow for 1 year, you're going to get so much. Okay. Now bond B is redeemable in 2 years time. They are paying a coupon of 6%. So first year they give you 6%. Second year also they give you 6%, plus they give you back the money. Today it's trading at 102. So what are we finding now? We are going to work backwards to find the yield for year 2 only. I don't want year 1. I know year 1 is so much, correct or not? Year 1 is so much. So what am I going to do? Same concept just now. Bond B. Okay, bond B is going to be year 0. Okay, year 0 I have to buy 102. Multiply by 1 is going to be 102. Year 1 I'm going to get $6. But I know my year 1 I'm getting a return. Yield curve individually. I'm not doing YTM here, okay? I'm doing 1 by 1. What's my return I'm getting for this actually? 3.88%. So I multiply with 1.0388 minus 1. So you're going to get here 5.78. Now year 2 is going to be, I'm going to get back my $6 plus my $100. But I don't know my yield for year 2. But I know it's going to be compounded for 2 years, because I will get back whatever I put in. Get a picture? So this is going to be the missing figure. How much must this be? Because these two total must give you 102. So that will be an answer of 96.22. Now you solve your R, solve this R, you will get 4.96%. Yeah, you solve your R, you're going to get 4.96%. Okay, good. Now bond C is going to help us to find the third year spot yield curve. Year 3 spot yield curve. The way you do it, the same way with bond B and bond A. It's individual yield. So bond C, redeemable in 3 years time, every year $5, today trading at 98. So what are we going to do here? Bond C is going to be year 1, year 2, and year 3. Year 1, year 2, and year 3. Now the yield curve, it's going to be $5, $5, $5, and $105. And I know the total price that are going to be is $98. I'm using the price approach, or earlier I used 0. This must be the price. This is the total price of this. This is 98. So first year I actually got 1.0388 negative 1. How much would you pay today to get this? So remember example 3. How much would you pay today to get this? This is what I'm going to pay today to get that figure. This is 4.81. Second year yield is 1.496. Yeah, 1.496 power of negative 2. Yeah, 1.496 power of negative 2. And this is going to be a figure of 4.54. So I'll pay 4.54 to get this figure in 2 years time, getting a return per annum 4.96%. So how much is this one going to be? This is the missing figure, which you have to find, and it's going to be how much? 88.65. Okay, 88.65, and this is going to be 1 plus R to the power of negative 3. So if you're going to get 1 plus R to the power of negative 3, you're going to solve it, and you're going to solve this alone. Yeah, you're going to take out separately this one. You're going to take this separately and solve the R. Is that okay? So I think that's not a big issue for this level kind of calculation. So your R is equals to, you should get 5 point how many? 8%, right? 5.8% is what you are going to get. So you know, notice that the yield for each year is different, because this is known as what? Spot yield curve. Is that clear? Using what? Government bonds prices to find the spot yield curve. So that was example 4, finding the spot yield curve for each year. Okay, now the last example the examiner have created for us is to learn how do you find your credit risk, credit spread, and all that. Now, how to determine yield curve? Okay, we have the yield. All right, let's take a snapshot of this. Okay, now you have the annual yield curve. This is what we have just now. And what you need to know is that there is a credit rating table here, the following table spread here. Following table of spread in basis points. Now let me just tell you, 100 basis points is actually equivalent to 1%. Yeah, 100 basis points, you should know this. Yeah, 100 basis points is equals to 1%. Now this is called the spread, because they will add on because of your credit risk. Yeah. Now look at example 5 using the two datas just now. Now let's say Mason Retail Company is rated AA. If Mason is rated AA, then the individual yield curve based on government bond yield curve for Mason alone. You see, the government bond one was how much? The government bond one was 3.88. But Mason is rated what? Mason is rated, let me just snapshot of this one. Okay, now Mason is rated AA. So for 1 year they have to borrow, they'll borrow at 3.88 plus another 29 basis point, which is equals to 29. Mason cannot borrow at 3.88 because they are a company, they are not government. Is that clear? They have risk, so people look at them differently, and they see your face, they say you're rated AA. Yeah, if you're rated A, you got to add on more spread. So in this case is 29, 0.29%. So how much you going to get here? Mason will have a cost to the debt as well as a 4.17 for year 1. Year 2 it will be how much? 0.41. Yeah, this is what you're going to have year 2, and your total up you're going to have here 5.37, and third one is going to be 5.8 plus 5.5, giving you an answer of how much? 6.35%. So basically all these figures are actually after the adjustment of spread. So you add on to your what do you call that, the yield spot curve or yield curve, and you're going to get this. Is that okay? So summarizing it, let's summarize the whole thing. We have 5 things here. By the way, this is written by your member, by your examiner. Yeah, those days it was written, the name was there. I just blocked the name here because now we're not supposed to reveal the name. Yeah. Now, so first example, we learn how to find the bond price using one yield curve. Second one, we found what's the yield to maturity. The third one, we also learn how to find the bond price using what curve? Individual yield curve. Is that clear? This is one yield curve, this is individual yield curve. Okay, individual yield curve. The fourth one, we try to find what? We try to find the yield curve itself. How do you determine the yield curve each year? Using what? Government bonds. The last one is going to be finding the cost for the company. Now, how much is it going to cost the company to borrow out there? So it's actually what we do here is the cost of debt calculation. Usually that's what we're going to be given. Usually the examiner likes to give you RF plus some spread. Is that clear? This is a common one now. Of course, you can also be asked to find your cost of debt using other methods like what? IRR method and all that. Is that okay? So this is how I make explanation for this this article that appeared in September 2011.